Joining us now to break down this latest June jobs number, we've got Joe Brusuelas, who is the RSM chief economist, good friend of the show. Joe, great to have you here on set. You were actually talking ahead of when we went live about this interesting dynamic about how if we see the jobs print, the non-farm payrolls come in higher than expected, then we might have actually seen this exact reaction in unemployment rate as well.
That's right. So look, guys, this is what full employment looks like. This is what you want to see. This is a very good number. Now, you know, the data viz we had up just before the number was released. You know, immigration's played a big role in not just growth of the economy, but growth in the labor market. Goldman put out that report, and they were right about that. It's slowed since March. And at one point, we're going to see these numbers come in a little bit lower. Last year, Jay Powell was talking about how he thought the break-even in overall monthly unemployment gains was somewhere between 50 and 100. Now, that was because we had that strong growth in labor supply. That's now slowing, so my sense is it's probably somewhere between 150 and 200 today. Nevertheless, this is another good, absolutely rock-solid labor report. There's not much to complain about here. Moreover, if you're a market player and you see those downward revisions of 111,000 over the past couple months, hey guys, that's Fed positive.
Well, so isn't this the perfect report for Jay Powell? So you've had inflation start to decelerate. You have downward revisions. You don't have a too hot report. That has to put a September rate cut on deck here.
No, it does. As a matter of fact, look, guys, a policy rate in a range between 5.25 and 5.5% is no longer appropriate for an economy that has an inflation rate of 2.6%. Taken out to 3 decimals is 2.563, right? Moreover, growth is cooling. Hiring is cooling. The economy is normalizing. We're moving back to that pre-pandemic trend. You know, the large and persistent shocks that we've all lived through the past couple of years, I think we often undercount that or really underestimate just what it's done to the economy. This is unambiguous good news here, guys. This is what you want to see. That fireworks show we all watched last night, they should rerun it again after this report.
I see this report, and this is not a stock recommendation. I'm thinking if I'm trading, this is a buy Nvidia, Apple type of market. Not too hot a jobs report. You have lower interest rates. I mean, why not just stick with what's working in tech?
I mean, well, you want to be able to mute at least one part of the kind of investment calculus, and so far muted. Higher for longer has meant the Fed's going to be muted, at least for this interim period, which has led to that exact trade that you're talking about, or at least solidified it. I'm taking a look at the CME FedWatch probability here and tabbing over to that month that you were just mentioning, Saz, and Joe, you were discussing as well here. We actually saw a slight tick lower, just barely here, but I mean, the probability is still largely pointing towards a rate cut.
They're not right. I'm right. That's right. Just close close that down.
The deceleration in hourly earnings to 0.3% on the month, 3.9% year over year, along with those downward revisions, that tells me we can take off the table any notion of wage inflation really being on the table. Guys, I'm more comfortable with the Fed actually hinting in July that they were going to go in September. If I'm a Fed member, I'm actually thinking about July. They want to get out in front of what's going to be a decelerating job market.
So, Joe, this report might be good for markets, tech investors, but is it good for the president? Now, he's had a rough week, and he may have a rough few more days, but you have a decelerating job market, and the unemployment rate is going to go up. On the weekend papers, you're going to see unemployment rate is on an uptrend, job market slowing. I mean, this is not good for him.
So my sense is that the U.S. presidential election right now is about things other than the U.S. economy. U.S. economy is going to be a second-order story probably through November 5th. Look, you know, headlines are headlines. The American people know 4% unemployment, that's really good. That means I can get a job, my wages are going up, and look, guys.
But they don't feel good.
So the economy has a funny way of trumping ideology and politics, right? At a certain point, that increase in wages above inflation does tend to take hold. Moreover, at the end of the day, what do we all see? We see them out spending. We see them out traveling. I mean, I gotta go to the airport tomorrow morning. We're leaving extra early because over at LaGuardia, it's gonna be a royal mess because people are out spending hard-earned money.
I mean, I know what I'm seeing.
They're doing well.
I spent $7 on a bag of cauliflower chips yesterday, and the bag was smaller. I mean, that's what people are seeing. I mean, and they're concerned. But anyway, I mean, your point is well taken. Your point is well taken.
You also cooked that tomahawk steak that you sent me a photo of.
Rope you off, ceremony for something.
So, I mean, at the end of the day, and I was taking a look at one of the notes that was out from BlackRock as they were talking about continued disinflation and allowing maintenance cuts here. You know, how do you look at disinflation as we're seeing it right now, and what that means for some of the positive developments that we would need to see towards the back half and continuing in the back half of this year to set forth a rate cut pathway, even more so in 2025?
All right, so the Fed has been really consistent on this. They don't need to see disinflation or inflation get to the target of 2% on the top line PCE. Our forecast says we're going to be at 2.3% by the end of the year. Look, guys, we're within shouting distance of it now. If you want to get out and get in front of this and not have the Fed be behind the curve, they need to begin shaping expectations, I think, of that rate cut in September. That's been our call for a long time. We've got 25 on the table in September and again in December. Again, but I'm comfortable even with them considering July at this point because I do think the growth in the economy, or the economy's just normalizing. I want to be clear here, guys. This isn't a crack in the job market. It's not the economy's foundations cracking. We're moving back to trend. You know, when I see 206, and I think they probably overestimated by 20 to 40, hey guys, that's sustainable. This is very good stuff.
Do you see a catalyst in place to drive a re-acceleration in these jobs numbers?
No, I just don't see that, right? You know, job openings are going to move up and down every month, but my sense here is that firms have retained labor for a very long period of time. Demand's now cooling. They're not going to continue to hoard labor like they have been. So we expect unemployment, our forecast was 4.2% by the end of the year. That's looking pretty good here on July 5th.
Yeah. 8 p.m., where are you going to be tonight, Joe?
I'm going to be watching the president talk tonight, like I think we all should. Yeah. Get out there and register to vote. It's important.
Joe Basuelos, always good to see you. RSM Chief Economist. We'll talk to you soon. Have a good weekend.